Mandatory Roth catch-up contributions and in-plan conversions. Let's break it all down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today we're talking about mandatory Roth catch-up contributions. That's something new that's going to be implemented starting in 2026 for your employer-sponsored retirement plans. And later on, we'll also talk about little in-plan conversions because that kind of ties in some ways to this mandatory Roth catch-up contributions. So let's start off with a little background on this mandatory Roth catch-up contributions here. So the rule comes from Secure 2.0, right? That passed in, 2022, right? Secure 2.0. And this rule itself didn't really go into effect until, the IRS published the final regulations, looks like November 17th, 2025. Okay, so it's set to go in effect starting January 1st, 2026. Okay, so there was a little delay there from when it was passed, and you might have heard about it or it floated around for a couple of years until the final regulations were published, and now it's going to be officially implemented starting January 1st, 2026. So that's why I kind of want to talk about it, because it's pretty timely. It is going to impact some of our listeners starting in 2026, and we'll get into kind of what the rules are and who this pertains to right now. So participation, let's start with a catch-up contributions review of catch-up contributions, right? So this episode, we're just talking about employer-sponsored retirement plans, meaning 401ks, TSPs, 457, 403bs, that kind of stuff, right? We're not talking about the catch-up contributions to regular IRAs. That's not relevant for this conversation, and there is no change as far as mandatory Roth contributions to your regular IRA catch-up contributions. Now, the catch-up contributions start at age 50, right? Once you're age 50 or older, you can start to contribute additional amounts to your workplace retirement plan above the standard annual limit, right? And the idea is, for those people who maybe didn't save enough early on, the catch-up allows you to kind of boost your savings retirement, right before you kind of head into those retirement years. And hopefully, these are the years when you're hopefully making the most wages and salaries, so you have a little more money that you can kind of sock away into these retirement accounts. So the catch-up contributions, again, we're talking 401k, 403b, 457, and TSPs. So the 2025 catch-up limit was $7,500. Okay, if you're 50 or older and you're already maxing out your contributions, which for 2025 was, I believe it was $23,500, you could do the extra $7,500. A lot of these numbers that I'm going to talk about are adjusted for inflation. They change year to year, right? So 2026, that catch-up contribution limit, if you're 50 or older, goes from $7,500 up to $8,000, right? So it jumps up $500. It's good to check year to year, because there are some years when maybe it doesn't change, and some years it changes a lot. Some years it changes a little. You just got to circle back and check to what the limits are in any given year. But to do an example, right? Let's say you're age 50 or older, and you want to max out your contributions plus max out your catch-up contributions in 2025. You can contribute a total of $31,000, $23,500 of regular contributions plus $7,500 of catch-up contributions. Now, another important thing to note is these limits that I just discussed there are talking about the employee's contributions, okay? The employer contributions don't impact these limits I'm referring to right now. Okay, so there's also something called the super catch-up contributions, and those are for 4 years when you're age 60, 61, 62, and 63. You can actually this is fairly new in and of itself. It just came out. I'm not sure exactly, but just recently. But the idea here is the super catch-up contribution is in those 4 years when you're 60, 61, 62, or 63. Instead of the regular limit, which is $7,500 for 2025, $8,000 for 2026, you can do up to $11,250. Okay, so it's just an increased amount of catch-up contributions for those 4 years. Why those 4 years? I'm not too sure. Why doesn't it continue on to 64, 65, or why doesn't it start earlier? I don't know exactly what the rationale was. But as it stands right now, you can start your regular catch-up contributions to your employer-sponsored retirement plan at age 50. And then for those 4 years, you're 60, 61, 62, 63, you can do the super catch-up contributions, right? So it's just a little bit higher. And then after that, I guess once you turn 64, it's back to the regular catch-up contribution limits. Now, from my understanding, the super catch-up contributions is optional for plan sponsors. So that's the interesting thing with a lot of this discussion is, and we'll get into some of it with the mandatory Roth catch-up contributions, is your individual plan sponsor, meaning, the TSP, or if it's, in power with the Island Savings Plan, or whatever it might be, whatever custodian or plan sponsor you have to run your employer-sponsored retirement plan, they can kind of, there is some optionalities here, right? Just because, you can do a Roth contribution doesn't mean your plan needs to offer it, right? It's an option. They're not required to. So the super catch-up contribution is optional to plan sponsors. So we'll see. We'll see what happens here. A lot of this, too, is so new that it'll be interesting to see how the plans implement this stuff going forward. A lot of times the regulation is passed, and regardless of how complicated it might be, it kind of is up to the plan sponsors to determine how they're going to go about implementing these things. Okay, last thing I want to cover, just to kind of recap about catch-up contributions, is for those individuals with the Island Savings Plan, the 457, there is a special 3-year catch-up. And the idea there is that if you haven't contributed as much as you are allowed to each year you are a plan participant, starting 3 years before your normal retirement age, you may be able to save up to twice the annual limit. Okay, so there's this special 3-year before your retirement age with the 457 Island Savings Plan. If you didn't max out your contributions previously, you can kind of boost the contributions, the special 3-year catch-up, they call it, to the 457 Island Savings Plan. Now, with that, you can't use the 50 and older catch-up and the special 3-year catch-up, right? You can't double them up. But the 3-year catch-up, there's a lot of information on that. Just kind of do a quick Google search or look at any of the Island Savings Plan 457 information you have from the state, and you can find it in there. So now let's go into this mandatory Roth catch-up contributions. Okay, how it works. So again, we covered 50 and up. You get the catch-up contributions. You get the super catch-up. And then there's the special 3-year catch-up with the 457. So what I'm going to discuss is pertaining to all of those catch-up contributions. The plans, the retirement plans that don't need to kind of comply with this are non-governmental 457 plans, simple IRAs, and then again, your individual IRAs. Those catch-ups are different. So the way this is based off of is a wage threshold. If you earn a certain amount over a threshold, then you are required to make your catch-up contributions as Roth, meaning you're paying the taxes on it, right? And then it grows tax-free, and you can take the Roth contributions plus the gains out tax-free in the future, right? But you no longer can take a deduction for the catch-up contributions if you're over this income threshold. Okay, and the income threshold for 2025 wages is $150,000. So for 2026, when you're looking at making your plan contributions and your catch-up contributions, what you're basing it off of is the previous year's wages. Okay, so 2025 wages are going to determine if you need to comply with his mandatory Roth catch-up contributions for 2026. Okay, so, and for 2025, it's $150,000. So that might go up, right? So when you're contributing to your plan in 2027, you're going to look at 2026 wages, and there might be a new threshold that was adjusted up for inflation slightly, and you'll see if you're over that threshold, right? So easiest way to determine if you're over it is look at your W-2. And in box 3 wages, social security wages, that's what you'll use for determining, if you need to comply with this or not. And it's not a phase out. If you're $1 over, right? If you're $1,000 over for that year, the $150,000, then all of your catch-up contributions need to be Roth. So now, some of you might say, well, what if my plan doesn't offer Roth option, right? There's no Roth contributions. And this is kind of interesting, and this is where the legislation's passed, and it's going to be up to the plans to kind of catch up to things. But plans are not required to offer Roth contributions. And here's the kicker, is if the plan doesn't offer the Roth option, then if you're over that income threshold, you can't make any catch-up contributions at all. Neither pre-tax or Roth, right? Because there's no Roth option and you need to comply with this. So you just can't make catch-up contributions. At least that's my understanding as how things stand right now. Now, we'll have to see how this plays out. This is new. Maybe some things change in legislation or some of the regulations in the future. But as it's written right now, that's what it's looking like. So if you're under the threshold, if you're under the $150,000 for 2025, you can still make those catch-up contributions to your pre-tax account. And if the Roth is optional, you can do the Roth contributions as well, right? So again, because the rule applies at the employer level, plan sponsors, they can automatically designate the catch-up contributions as Roth for the employees who are affected by this. Meaning it all depends on your plan, but I know like the TSP came out with an email saying that they're going to automatically, I guess they take a look and they understand what your wages were from the previous year. And once you kind of meet that threshold and you're making catch-up contributions, from what I read, they know that this applies to you or doesn't, and they're going to auto-designate your catch-up contributions as Roth. It's not something that you need to manually go in and do and make sure you comply with. Now, will all plans do that? I'm not sure, and each plan is going to be slightly different in how this is implemented. So you definitely want to check with your 401k provider. I have to look at what the 403b and 457 say about this. The fact that it's auto-designated is kind of beneficial because you as the employee don't need to keep track of this yourself to figure out, okay, when was I making pre-tax contributions to the plan, and when do I have to start switching over to the catch-up and make sure that it goes into the Roth bucket? And then what if I mistakenly contributed too much to the pre-tax and it should have been Roth? Now I got to correct this. So you can see it can be a headache if you got to manually keep track of this yourself. So hopefully all the plans follow suit. The TSP announced that it does, and it'll just change your contributions automatically to the Roth for the catch-up contributions if you're over this income threshold and the rule applies to you. So what if you're a new employee, right? You just start at a company. Well, you're from the way the rules are written now, you're never affected in the first year, regardless of compensation. So you kind of get a fresh start because you didn't work within that plan and that employer, and you don't have any wages. So new employees are unaffected. And likewise, maybe you start halfway through the year, and so you don't earn the full year's salary. So, when you look back at those wages for in the following year to see if you need to do the Roth catch-up contributions, maybe you didn't work the full year, so you stay under that income threshold. So some things to consider with this mandatory Roth catch-up rule, right? There's some short-term impacts and long-term impacts of being forced to do these mandatory Roth contributions if you're over that income threshold and you're affected, right? First off, if you have to do this, your take-home pay is going to be lower, right? Because instead of getting the tax deduction for your catch-up contributions and those contributions going in tax-free, right? You don't pay the taxes; you pay it when you pull it out later. Instead, you're going to pay the taxes now, right? You don't get to delay it, and so your take-home pay is going to be lower if you make those Roth contributions. A secondary effect to that is you'll lose the ability to reduce your taxable income, right? Because if you were able to do the pre-tax catch-up, then you're also reducing your taxable income for the year, and that might affect other things, tax brackets or maybe qualifying for certain deductions or exemptions or whatever it might be, right? Now, with this mandatory Roth contribution changes, it's not necessarily a bad thing, right? Because you still get to make your contributions, and it might work out in your favor. Yes, you're going to pay a little more in taxes now, but keep in mind, if tax rates rise in the future, then maybe it's a wash, right? Maybe it turns out to be a good thing, and this money is still contributed in retirement accounts, growing tax free, right? If it's in the Roth bucket. So it's not the end of the world if you're subject to this, if you're over the income threshold. You got to look at where that puts you for your taxable income for the year, and decide, maybe depending on what you have going on, if it's a good thing or bad thing, or if you want to continue to do that. It's always good to have some tax diversification, at least in my opinion. If you have all your retirement money tucked away in traditional pre-tax assets, then eventually the RMD train is coming, right, later on down the road, and you're going to have to take distributions from those assets at some point and pay the taxes on them, right? So, you just got to look at how this impacts you. There are a lot of considerations when it comes to the whole traditional and Roth conversation. I've heard experts in the field who constantly advocate for Roth because of the fear of increased tax rates down the road. And I've heard opposite opinions on, for high earners, always take the deduction, like no questions asked. Take the pre-tax, right? Lower your taxable income now, and worry about the taxes later, right? So you just got to figure out what works for you, how this fits into your plan, really. Okay, so let's leave it there right now for the mandatory Roth catch-up contributions and switch over to talk about Roth in-plan conversions. And what Roth in-plan conversions, what we're talking about is, again, we're focusing on employer-sponsored retirement plans, and we're talking about conversions while you're in service, right? You're still working at the employer, still participating in the plan, whether that's a 401k or 403b or TSB. And while you're in the plan and still working there, you do a conversion, meaning you move some of your funds from the pre-tax account within that plan to the Roth bucket. And by doing that, you're just transferring money over within the same plan, and you're essentially just doing a conversion. So you're going to pay taxes on that money, the amount that you converted from pre-tax to Roth within that plan, and the rules differ kind of dramatically between plan sponsors, right? Again, we go back to a lot of this is heavily dependent on your plan sponsor, whether they even allow some of these rules, and then and also how they go about implementing them, right? Maybe there's like a minimum amount that you can do for these in-plan conversions, or maybe there's a frequency rule, or you can only do one per year or one per whatever it might be, right? So a lot of this is dependent on the plan sponsor. So you want to kind of get in touch with them or look at some of the information they provided to see what rules are around this in-plan conversions. What we don't want to confuse this with is in-service rollovers. In-service rollovers means you're moving money out of the employer plan into an IRA, which also is optional and is dependent upon the plan sponsor, but something you can do. You can still be working and participating in your employer-sponsored retirement plan and decide you want to roll money over into an IRA, let's say, right? So you take a portion of your employer-sponsored retirement plan and you do a in-service rollover into an IRA. Okay, what we're talking about is doing a Roth in-plan conversion. Okay, so we're just staying within the one plan, the retirement plan, and we're just doing a Roth conversion. Okay, so we're moving money from the pre-tax bucket to the Roth within your retirement plan. Okay, so let's talk about with Roth in-plan conversions, what can be converted, right? So first of all, the money has to be vested, right? They're not going to let you. Most plans aren't going to let you do this in-plan conversion for amounts that aren't vested yet, right? Now, let's say within your plan you have your contributions, you have your employer match. Maybe there's like an automatic, like TSP is the automatic 1% contribution. What's going to happen is if these are vested funds and you do this in-plan conversion, you're going to do this Roth conversion within your retirement plan. The most common thing that you'll see is it's going to come out kind of proportionally or pro rata from all these different buckets when you do the conversion, right? So for instance, let's say, half of your plan is your own contributions, and then half of it is matching, right? Let's just say for simplicity's sake. When you go to do a Roth conversion, and let's say you do $10,000 of in-plan conversions, then $5,000 of that will come from your contributions, $5,000 of that will come from the matching contributions. That's typically how you'll see it, is it'll come out proportionally within the different monies that are invested in your plan. So let's talk about why a participant would use an in-plan conversion. Really, you would do it if you got to be thinking long-term in some sort of tax strategy, or it could be short-term, I guess, but you're thinking about building tax-free Roth assets. And usually there's a reason for it. Maybe you expect to be in a lower tax bracket later on, or you fear that tax rates are going to rise drastically in the immediate future, or maybe you want to reduce future RMD exposure, right? One of these reasons is why you would do it. There's some sort of tax planning aspect that you have in mind of why you'd want to do this. You're not just doing it for the fun of it, right? There's definitely a tax strategy and tax reason behind it. Now, what that is all depends on what you have going on and what your reasons are for doing it. Now, with this in-plan conversion, you got to keep in mind that there are withdrawal and distribution rules. For instance, the Roth 5-year rule, it's the 5-year aging rule for the tax-free qualified withdrawals. And that 5-year clock is gonna apply to each Roth conversion, right? Up until you reach your 59 and a half, right? And the whole idea there with these 5-year rules was they wanted to do away with at least the conversion 5-year rule. They want to do away with the loophole of, I'm just going to convert the money and I'm going to take it out, right? Because with an IRA, right, you can have pre-tax money in there. You can convert it to a Roth IRA, and the way the rules are written is you can pull your own contributions that are in a Roth account out at any time penalty free. And so the way they kind of threw cold water on that is they had this 5-year rule for conversions, right? So that's something to keep in mind as well with these in-plan conversions. So another thing is there's some key considerations before you go about converting, right? You got to keep in mind that when you do this in-plan conversion, you can't withhold taxes from the conversion, right? You have to have the ability at the end of the year when it's time to tally up your taxes, to pay the taxes for that conversion from your personal savings or from other money, right? You can't withhold taxes from these in-plan conversions, right? And this in-plan conversion is going to have an impact on your current year tax bracket, right? It counts as ordinary income when you do these in-plan conversions. And like we talked about earlier, the reason I wanted to bring up in-plan conversions is, now with the mandatory Roth catch-up contributions, there's a little more thought and maybe of how you're going to coordinate the two to get the best situation for you, right? And I think that's about a good place to leave it for in-plan conversions. I just want to touch on it real briefly because, again, when we're talking mandatory Roth catch-up contributions, that might impact how you approach Roth in-plan conversions if you're doing them or if you planned on doing them in the future, right? It all kind of ties into each other. It's good to have, I know this stuff can get really technical and in the weeds, and you might be saying, all these numbers and how do I keep track and I don't know what I'm planning for. It can be really straightforward as well, though. A lot of times the regulations and the rules just get layered on top of each other, and it's a lot of simple rules that add up to a lot of complexity only because of the amount of rules layered on top of each other. But it's not all that daunting and shouldn't be all that scary to approach. But again, if you haven't already and you're approaching retirement, taxes is going to be a big part of how you go about managing assets, how you go about setting up a plan for your investments in retirement. If you haven't thought through a tax strategy, that's okay, but maybe start to give it some consideration and think about how you want to approach it. You can always seek out a professional, CPA or financial advisor to help you along with that too. But that's all I wanted to talk about today is the mandatory Roth catch-up contributions and in-plan conversions. I'm sure you'll be getting some emails and some correspondence from your plan sponsors on the mandatory Roth catch-up contributions. And we'll see how this plays out and what changes in the future. That's the thing, is the tax code, they say, is not written in stone, right? I mean, it's always subject to change. And we don't know what's coming down the line with different legislation and, especially as different political parties kind of pass the torch and the powers that be there in Washington. We don't know what's coming, right, with tax rates and a lot of this stuff. But it's good to stay up on and establish a plan and factor this all in and figure out what the best approach is for you. Okay, so I think coming up this week, we're going to have on SHIP, that's the State Health Insurance Assistant Program. And I'm interested to talk to them. They kind of help out with a lot of free resources and information around Medicare and Medicaid. And they offer a lot of great information. I'm excited to talk to them this week. But as always, if there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and I'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Katita, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.